In this example video, we're going to look at the operating activity section for the statement of cash flow under the indirect method. And we're going to look at some things that we have to think about before we even get into doing this partial statement of cash flow. So when we're thinking about the indirect method for our statement of cash flows, what we do in our operating activity section is that we start with our net income. And we know that net income doesn't reflect cash. It doesn't reflect a cash value because we follow the accrual basis of accounting, which means that we record our revenues and expenses in the period that they're either earned or incurred, regardless of when we receive or pay out cash. So I can't just say my net income number is a cash number, but my net income number is going to be this starting point for us in our operating activities section for our statement of cash flow. And basically what we're going to try to do is we're going to adjust net income first for items that would be on our income statement that would either have no cash impact or would be handled in another section of our statement of cash flow that we don't want to double count. And then we have to look at our current operating assets and liabilities. So before we get started over here on the right-hand side, you'll see some things that to think about. So GLAD, gains, losses, amortization, and depreciation are 4 items that would impact our income statement and therefore impact net income that we want to adjust for in order to get to the cash value. So when we're talking about gains and losses, we're thinking about gains and losses on the sale of investments or on the sale of fixed assets or intangible assets. So if we have a gain, it of course adds value to our net income. If we have a loss, it takes that away. So we know that on a statement of cash flow, any sale or purchase of any non-current assets for cash are handled in our investing activity section of our statement of cash flows. So we do not want to double count those gains and losses by having it included in the net income and then included when we get to our investing activity section. So we want to reduce and reverse that impact that it had on net income here. So like I said, gains increase your value of net income. So if we want to reverse the impact on net income, we're going to subtract that away. Losses bring down our value of net income, so we want to reverse that effect and add it back in. Amortization and depreciation. We know that we amortize intangible assets like patents and copyrights, and we depreciate fixed assets, things like our buildings, equipment, vehicles, machinery, all of those types of things. And if you think about the journal entries for either one, and we'll just use depreciation as an example, we debit depreciation expense, which means that expense is going to hit our income statement. It's going to reduce our overall net income, but we don't credit cash. We never spend out any money for depreciation and amortization expense. It's just simply a way of reducing the value of a long-lived asset because we're using it to help run and operate our business. So depreciation expense is our debit. We credit accumulated depreciation. So although amortization and depreciation would reduce net income because it's being an expense, it would have 0 impact on our cash flow. And remember, that's what we're trying to get back to in this financial statement, our statement of our cash flows. So we'd add both of those back in order to reverse the impact of the expense that was on our income statement. When we get to our current operating assets and liabilities, again, really think about the cash impact that you're going to have. So when we're thinking about current assets, I'm just going to use accounts receivable as our example. So if you think about your accounts receivable, when your accounts receivable increases, that means you've done sales of either your products or services on account, meaning you are going to receive money sometime in the future, but you haven't actually received it now. So any increase in your current assets actually has a negative impact on your cash flow. That's wonderful that we are going to receive cash sometime in the future with accounts receivable, but we don't have it now. Versus, again, we're just using accounts receivable as an example, but when my accounts receivable goes down, The reason why it's going down is that I finally have received the cash that I was owed. So cash is flowing into our business. So we have a positive cash inflow because our accounts receivable is being reduced. So when our current assets have decreased, it has added value to our cash flow. On the opposite side, when we're dealing with our current operating liabilities, if my liability goes down, so think about accounts payable, if I owed a supplier money for the purchase of inventory, when I pay them, the only way that I'm paying off that obligation is to give them cash. And if I'm paying out cash, that's reducing my cash flow because it's a cash outflow. So any decreases in current liabilities are subtracted for your statement of cash flow. Any increase in current liabilities are added. Again, think about accounts payable. If you go to the store today to purchase something and you have two cards in your wallet, you have your debit card and you have your credit card. If you swipe your debit card, cash would instantly come out of your checking account. But if instead you swiped your credit card, you're holding on to that cash that you currently have in your checking account. You are going to have to pay that Visa bill sometime in the future, but as of right now, you're holding on to that cash, keeping it as a positive cash flow. So any increases in current liabilities, we are going to add into that net income starting point for us in our operating activity section. So we have a bookstore. They said they reported net income for $62,000. They also told us that there was $5,000 in depreciation expense, that there was a $5,500 increase in inventory, a $2,000 increase in accounts receivable, and a $1,250 decrease in accounts payable. So again, we're doing the indirect method here. So we're going to start with our net income. That is our starting off point at $62,000. And then we have to be able to adjust that $62,000 for cash items. So depreciation expense. It's one of those glad items that we have over here. So depreciation expense, they told us was at $5,000. There's no cash impact for that expense, although it would have impacted our net income. So we're reversing the effect of that by adding it back in. They told us there was a decrease in accounts receivable. That's a good thing. The reason why our accounts receivable is going down means that cash is flowing into our business. So we're going to add those two items. We also had an increase in inventory, and our increase in inventory was at $5,500. That's going to have a negative impact on our cash flow. If my inventory values are going up, that means I had purchased more in inventory, so I'm spending out cash, but I'm not selling it as quickly, so I'm not turning my inventory fast enough to benefit from that cash flow coming in. So it has a negative impact on our cash flow. And then we also have a decrease in accounts payable. And again, think of it like paying off your credit card. We all love to pay off our credit card, but by doing that, it reduces our overall cash. So we have our net cash that's been provided by operating activities. So it's been provided by because it's going to be a positive value for us, and it's provided us a total of $62,250 in cash.